This is a short video, part 3 in our series. Actually, part 4 because we did something on depreciation. And this is the retained earnings statement, which is a function of the balance sheet, the income statement, if you watch the first 2 parts of this series on financial statements. And it's a relatively simple statement. And once again, I should reiterate that you will see these type of statements from the smallest company to some of the largest companies in the world. So this is where you would have begun the year for this particular company. So they started the year with $1,012,000 of retained earnings. And retained earnings are basically when a company makes a profit. At that point, they have a choice to pay dividends to their shareholders. They are obligated to pay dividends to their preferred holders. And then once they've done those things, they've elected to pay dividends to shareholders. They've elected to pay dividends to preferred holders. Oh, that's not an election. Preferred is obligation, but dividends for common is an election that's determined by the board and on advice from the executives. They make those payments, and once those payments are made, then whatever's left over gets plowed back into the business. Goes back into the business. So one of the concepts that we'll probably be dealing with later is, how do we fund our business going forward? And that's a function of how much retained earnings we keep in the firm and how much we actually distribute to our shareholders as a dividend for investing with us. And sort of, you're an investor and you're going to see some sort of immediate cash flow. Now remember, if a company doesn't pay a dividend, that's something I should mention. You can always create your own dividend. If the stock goes up, you can sell some of the stock and make some of the dividend. But that's obviously predicated on the stock going up for it to be a positive return. But that's just an aside. At any rate, so retained earnings is one way to fund future projects. The other 2 ways are either offering more equity or taking on more debt. Well, at any rate, they started the year at $1,012,000, and if you go back to your income statement, they made $231,000 last year. This company earned net profits after they paid their taxes, because that's the point where you can distribute. That's not the cash flow. The cash flow then the depreciation gets added back, but the net profits after taxes is where we start the process of seeing what our retained earnings are. Okay, so then after that, we pay our obligated preferred dividend of $10,000. And in this case, the company elected to pay $98,000 to their shareholders. So when you add those together, you're going to get a number of 108. The sum is up here. And when you net these numbers out, you've come out with a positive number, because 231 minus 108 means that the company is going to retain 100, and I've got to do the math here. 231 minus 108, terrible simple math. 231 minus 108 is 123. So it looks like they're going to keep $123,000 of earnings and plow it back into the firm. So we're going to see a difference of 1,012 plus that 123, and we come out with 1,135. So that's the retained earnings that are going to go back into the firm. That's the number that the company has retained in terms of their prior earnings that they did not pay in dividends. And hopefully that's another good introduction into how these statements work. The next one will be the statement of cash flows, and then we're going to go over some technical stuff in terms of your obligations when filing financial statements. But this is a short video, but I hope it helps. Thank you.